Hello, I'm Roger Peterson, and welcome to Market Call. Richard Fogler is on the show. He's the Chief Investment Officer at Kingwest Company. He'll be taking your questions on North American Equities. The number to call, 1-855-326-6266. You can also send us an email if you're feeling a little shy, marketcall@bnnbloomberg.ca. And Richard, thank you very much for joining us. Good to see you.
Nice to see you.
Looking nicely tanned.
Thank you.
I'm jealous. One day of sunshine, and this is how you look, eh?
Well, I spent the weekend outside.
But it was perfect, wasn't it? It was so nice to do that. We've got lots coming up on the show, and this has been a last little second here. What do we have coming up right now? Because I'm not going to lie, I'm hosting the show for the first time in about 7 months, and we haven't had it. Do we have a caller right now? Okay. Okay, we're just going to talk about the general markets right now. I'm learning on the fly with this on this show. Your thoughts on what's going on? It's been interesting. I like using the word interesting because that's what it's been. How do you even figure this one out?
Well, the one thing is when you ask that question to most people, they are going to tell you what they think is going to happen because of Trump, because of Carney, because of the economy. We have when we buy things and hold them for a long time. Yeah. 5 years, sometimes a lot longer. So if you think about it, if we're going to hold it for 5 years, there's going to be there are recessions bear markets every 4 or 5 years, on average. So everything we own we're going to hold it through a bear market. So we don't worry too much about it. We don't fret about them. We don't try to forecast them. What our strength is finding companies that we believe will compound their value through positive change over a period of years.
There has been talk that I heard from a couple of people saying we may see Canada in a technical recession after this quarter.
Technical recession is an interesting thing. I mean, it's generally considered 2 quarters of negative economic growth. Yeah. First quarter was negative, very possibly second quarter will be as well. But we've actually had 5 years of negative GDP growth per capita. Mm-hmm. It's just that our population has expanded enough so that the economy itself has gotten bigger. But we have each gotten poorer, and we've been doing it for 5 years. That to me sounds like a more of a recession than the big number. That's the stuff that matters to people. So I think that's sort of moot whether it's technical or not. The big thing is we have to get this economy back kicking, and fighting with the United States is not a big way to do it. They account for 20% of our GDP, and it makes sense because if you had a business started in North Bay, starts to do well, you decide you're going to go to another country, you can drive couple 100 miles to the United States, where you can go find Afghanistan there on a map where there are no people and no buying power. Yeah. The United States is not only close, but it's also got the biggest buying power anywhere. Yeah. So, getting into a competition like that with the United States is, to my mind, going backwards.
Not a battle we want. What are you doing then with the markets like this? I mean, you hold for longer, but when you look at this, what do you see opportunities, or just kind of?
We usually we own 25 stocks in Canada, 25 in the States. In general, we're pretty much there now. I think we're 23 or 24. We've bought a couple of things this year, so both some in Canada, some in the United States. This market turmoil creates dislocations, price dislocations. Price dislocations are good for people who have money and want to buy things.
Yeah, of course.
So it's been okay, and they've done fine, and we're pretty,
You're happy.
Not happy, unhappy yet.
All right, we got to take a break on that note there, but we'll be back with Richard Fogler of Kingwest Company, taking your questions on North American Equities. Welcome back to Market Call. Let's get right to the emails. This one is from Dan, and the subject is, can Richard comment on Oracle? Go ahead.
Sure.
What would you like? Okay. They just signed a deal with an Australian data center, Datapod. How about that?
So let me say first, we don't own Oracle. And so when you got to understand that when you don't own something, your knowledge is not as good, A and B. I'm not quite sure why I would take my opinion if I don't own it, if I don't want to buy it myself. The big thing with Oracle is this: it has been a major company for a number of years. It's just transforming itself to an AI powerhouse.
Yeah.
This year, it's going to spend $50 billion on infrastructure, capex. Last year, it spent less than 25. If this stuff works, and if they get if they can earn high rates of return, it'll be terrific. Stock was $300 at the end of the year. It's 170 now. The trouble is, if it doesn't work,
they're in trouble.
They're in trouble. So you got to make a guess, pick your poison. Larry Ellison has certainly been as successful an entrepreneur in the tech space as anybody. You could have confidence in him, or you could say, hey, they're changing their stripes completely, and it's jump ball.
I asked this before. Do you think did you think he got distracted with Netflix and everything that was going on with Warner Brothers?
No, I mean, it's his son. He's putting up, he's putting up the guy's worth something like $200 billion. Yep. He's kept most of his stock. Many of the tech entrepreneurs have sold off over time. A lot of their stock generated money. Yep. He's actually kept most of his stock, and he's borrowed against it to finance things. And that's what he's doing with Netflix as well. But he's got so much of the stuff. You throw 100 million. You're talking. I'll throw 100 million here, 100 million there. I mean, it is.
It's chump change, right?
It's nothing.
All right. Okay. So
I hate to say it, unless it'd be better in my pocket. But other than that,
okay. Let's get to the phones. John from London, Ontario. What's your question?
Good to see you, Ross. Please host more often. I find you summarize market data very well, and your delivery is smooth and unpretentious.
Wow.
Hello, Richard.
Hi.
Good timing
Thank you, sir.
for private capital. You're the expert.
I am.
At your suggestion many years ago, I bought KKR, and I've done quite well. But KKR has suffered, has been lambasted by the denigration of private capital recently. It seems to be coming back. I have a pretty big position. Should I hold it, or should I cut a little bit? Thanks very much.
Thanks, sir.
Well, if you've been holding it for a long time, you're making a lot of money. That's good. Notwithstanding the fact that it's pulled back 25 or 30% in the last roughly a year.
Yes.
I think the KKR is, let me say maybe I'll give you the answer. I would hold, we own it. We haven't sold any. So, and we've owned it for 12 years, I think. Something like 2012, 2013, we bought it.
So you've done all right since then, 2013?
We've done pretty well. I think we
$20 there?
I think we paid $13.
Oh, yeah. So before
maybe $14.
Before that, just looking back, 2012.
So, so I can't complain. We still own it. We still like it. There are two things driving the business. One, institutionally. The institutional business has pretty much grown as much as it's going to grow, I think. Sovereign wealth funds, like Mr. Carney just announced today, they'll continue to grow. But other than that, I think the institutional business is pretty much maxed out at 35, 40% of their portfolio in this stuff. But there's been a wide range of people in it. In the last 3 years, the industry itself has been flat or shrunk. Mm-hmm. The big guys, KKR, Blackstone, RACE, Apollo, pick your poison. They're all growing 15 to 20%. Last year, KKR added $129 billion to their AUM, a 21% increase from the 630 they had before. So we like that. Secondly, the U.S. has opened up the retail business, which has been very slow to develop, just starting to take off big. The retail business is considered potentially bigger than the institutional business. Second, the brand names, KKR, Blackstone, RAs, Apollo, BlackRock, these guys will capture I think they will capture a bigger share than they did in the institutional business. So I think there's a huge opportunity there. The elephant in the room is private credit. That's what's hurt the stock. Everybody's saying it's going to be bad. There were a couple of defaults last year in credit. Neither of those had any private credit investors. Nonetheless, it trashed the private credit industry. 2026 will probably have some trouble in private credit, but nothing that won't be easily handled. Blackstone, just announced their quarterly earnings. They wrote down their private credit portfolio so that the return in the quarter was zero. Not exactly a terrific return. On the other hand, if that's the catastrophe, and otherwise they've been making 9-10% in an interest rate world, it's 3, 4, 5. It's pretty good.
All right.
So, I think this thing will correct itself. These guys, most of these guys, KKR in particular, a large portion of its business is going through to insurance companies. Most of those insurance companies are required to have investment grade loans, so most of them are. I think they're going to be fine. I think the stock's going to do great. Hold on for a couple more years. We expect to do that. I expect to see it considerably higher.
Okay. On that note,
hopefully I'm right.
On that note, we're going to take a break. We'll be back, though, with your calls and your emails after this. Richard Fogler of Kingwest and Company taking your questions on North American Equities. There's a number to call us at. All right, Richard Fogler's here, the Chief Investment Officer with Kingwest and Company, and we're going to get right to the phones. Joe from Montreal, what's your question?
Hi, I want to ask a guest about TD Bank. I'm up about 60%. I'm a senior. It's in my cash account, and they seem to be getting close to fully valued again, the banks, and it's almost at its yearly high. Actually, I think they're all-time high, and I wanted to know if he thinks I should be taking some profits now, and I was thinking of taking some and put it into a covered call bank ETF for the income, and I'd like his opinion about that. Thank you.
Well,
all right.
Okay.
I mean, the banks
well, we own TD Bank as well, owned it a long time. As you know, TD Bank went through a couple of bad years where the money laundering fiasco slaughtered the stock. You can see it on the chart in front of you. And it's now recovering. And but it's recovering. Remember that and so the bank is now back on track. Remember that they own the sixth largest bank in the United States from nothing 15 years ago. It's pretty spectacular thing they've done. Canadian Bank is excellent, as everyone knows. I happen to think it's very good. I think the U.S. Bank will continue to do well. They have some restrictions. Those restrictions really aren't that difficult because banks want to arrange loans. Banks want to focus on the customer, not the asset. They want to arrange loans, not necessarily hold them. So they can arrange loans and then sell them off to private equity because private equity is just the opposite. They want to own the loan. They're not really into the customer relationship. They don't do foreign exchange. They don't get fees for this, for that, and the other thing. They get an interest. So I think the U.S. will continue to do very well. I think Canada's doing well. The stock is cheaper than the other banks. Still, it would be my belief that you should hold on for a while. I think it's going to continue to do well, and I think all the banks will continue to do well. Canadian banks are in.
Are they priced to perfection right now? Or?
Yeah, they're high, but you could, if you just take a look at a chart of Canadian banks over the last 20 years, it went like this. And so it's got some blips there.
Yeah, I know everybody keeps waiting for it, don't they?
Yeah, I mean everybody's trying to outsmart things. Dividend's still pretty good. It's going to keep rising. Dividend will rise 6 times out of every decade, 6 years out of every decade. I can't tell you which 6 years, but but that's that's pretty normal or more from the Canadian banks in general. So I think TD is one of the cheaper banks. I don't see any reason to sell it, and I don't want to talk about covered call. We don't do it, so I don't think I should talk about it.
All right, well, then we'll move on, and let's go to Vancouver. And Karen, what's your question?
Hi there. I'm a retiree, and I'm constantly hearing from different experts about this bear market that is coming, and specifically worse than the 2008 or COVID. So I'm wondering your thoughts on really moving into more of a cash position. I already hold a conservative 20% cash position. I'm thinking about going to 50% and then putting, targeting the equities into financial, consumer staples, utilities, industrials, et cetera, all the defense ones, and really investing only in companies with no debt. And the nature of Canadian banks, actually, that they do carry debt. So I know historically Canadian banks have never cut the dividend or stalled the dividend, but with the Canadian economy where we're moving forward, it makes me a little nervous.
Okay.
So what are your thoughts?
All right. Thank you for that, Vicki.
Can I ask you a question? Are you a recent retiree or you've been retired for a long time?
Very recent, 6 weeks.
6 weeks.
I'll go with that's recent.
That's
Okay.
newbie.
So you are probably in your early 60s. You will probably live, according to actuarial tables, probably live to 85. You've got 20 years. If you're 50% cash, you're going to make a few percent. You're going to pay some tax. You've got some inflation at 2.5%. You're actually going to erode your capital. That does not seem to me a particularly good strategy. The second thing is you've got a long time to go. You're not a short-term investor, you're a long-term investor. We may be going into a recession. We may not be going to a recession. One thing I can tell you for sure, I can't tell you whether it's going to happen. And I'm confident to tell you that nobody else will either. Mm-hmm. Some people say it's going to go into recession. 3 years from now, it will have gone into recession. They'll say, look how smart I was. But the fact is, calling a recession, and in order to get to do it right, you have to not only call a recession, you have to call the bottom and buy. That's just too hard. Take a look at a chart of the Toronto Stock Exchange, the New York Stock Exchange, any other stock exchange in the world for that matter, but those two charts in particular, in the last 50 years, the chart goes up and to the right. Yes, it's got some blips. Yeah, that's not so comfortable. But if you look at it, it goes up and to the right.
Yeah.
That up and to the right goes at about 8 to 10% per year. The trick for an investor is to get on that line and hold on. That's how you will do well. Don't worry about trying to outsmart something you can't do. The experts can't do it. You're not going to do it either. Just the easy thing is get on that line and it'll carry you up and to the right.
All right.
And you'll and yes, you'll have a setback for a year. On average, 11 months every 4 or 5 years. Big deal.
We've had about 4 of those in the last 5 years.
Actually, no. We've only had, depending on how you count them, we've only had 5 bear markets in the 40 years I've been at Kingwest.
But the last 5 years have had some incredible dips, though, haven't
they? Have some blips, but that bear market's considered a drop of 20%. If you want, you can fool around with how deep it is and how serious that is. And some of them, as I say, the GFC in 2008, mm-hmm. Everybody thought the world was going to come to an end. It only lasted 8 months.
And it was over.
It was over. The catastrophe in COVID lasted 30 days. The end of February, at the end of March, end of March, something like that. The market started to go up. Some sections more than others. Obviously, it was the stay-at-home stuff that really boomed. But the trick for an average investor is to be invested, be diversified, get on that market line, and let it carry you to a comfortable retirement. Trying to do something that is virtually impossible to do is ridiculous.
All right, we've got to leave it on that note there. We're going to take a quick break. When we return, we'll take a look at Richard Fogler's past picks. That's next. Time now for Richard Fogler's past picks. And first up, we have got Brookfield from September 5th, 2025. So about 7 months ago. Brookfield's had a bit of a ride, hasn't it?
Yeah.
It's down 30, down 24% over the last year.
I think that's partially counting I think that's counting the fact that it's split for two.
Oh, okay. So yeah, the board might be a little soft.
Yeah, I think Brookfield. It'd be in the it hasn't just allow me to.
What's that? It's at 45 right now. Is that
No,
right?
that's Brookfield Asset.
That's
Brookfield Corp
Asset. Okay,
is 60.
We're doing this on the fly. This is live TV, everybody.
Yeah. It looks. Let's see, in the last year, you're asking me. So there's the chart. That's the chart from the left. Just September 5th. So that's here. Yeah, it's still marked the same. Yeah, it's gone. That's the thing.
Yeah. Okay, so we say.
I think that chart doesn't incorporate the split. Oh, excuse me, I'm looking at the wrong thing. Pardon me.
All right. Do you still like it where we're at here?
But I like it. Yes, I do.
What do you like about it, so?
Notwithstanding that, I couldn't find it on a list.
Sometimes live TV is live TV.
It's a private. It's a company. It's again in the private equity business, fees, and it owns things. If you add up all of the values of the things it owns that are public, you get a price of somewhere in the area of $65.
Okay.
But it also owns a massive real estate portfolio. Canary Wharf in London. The portfolio's been doing great the last 6 months. It was having some problems. It's now leasing out very well. New companies are buying buildings and building new buildings. Manhattan at Hudson Yard, renting at the highest rents in the city. You can't get space. And Toronto First Canadian Place and things like that. They have the highest quality office buildings valued at zero in that stock. We believe the thing's worth 90 plus. It's trading at 60. The difference is, I say, is the real estate, which is all private, is private. I think it's a wonderful storehouse of value and a great management.
All right, let's get to the other two: secure waste infrastructure.
Secure waste.
How did we do it? Let me see. Recommended at 1660 up to 2330.
Yeah. So secure waste there's an offer to buy it by GFL Environmental. So it's up, whatever it is, 40. We made 40%. We're going to be taken out in the next little while.
You going to be getting out?
Well, it's being taken over. We don't have a choice.
Okay. Yeah, it is, isn't it? I'm assuming it's going through.
Right.
That's right. That was just a couple of weeks ago, wasn't it?
Yeah.
So you liked how it went, where it went?
I actually thought that we should have got a higher price, but you get 80% of what you're doing is in stock, and so I think that's okay.
Okay. Last one is Amrise out of New York, and it was at 5364, 5755 now.
Yeah. So Amrise is basically an infrastructure business. It's quarries, local. These are all local markets. You can't ship stones long distance, too expensive. It was a subsidiary. It was the U.S. subsidiary of a company called Holcim, one of the biggest cement companies in the world. They spun it off in June. The fellow who was CEO of Holcim became CEO of this new essentially subsidiary, Amrise, although it's independent. That almost never happens. He then went out and bought $100 million worth of stock with his own money. That never happened. Paid about between $48 and $50 for it. The company has been, because it's an offshoot subsidiary of a large company. It's got lots of things they can do to clean up their profitability. Yeah. Very good. They've also got lots of opportunity now to reinvest, and they don't have to ship a lot of the money off to head office, which they used to do. All of which is good. We think over the next couple of years, there's going to be a huge winner.
Okay, we'll leave it on that.
And it's in the infrastructure space, which is considered to be a gold mine.
All right, we'll leave it on that note there. We'll be back with Richard Fogler of Kingwest Company, taking your questions on North American Equities. Richard Fogler is here from Kingwest Company, and our emails are going as well. And first up is Vicky. I have recently dipped back into building and wonder your thoughts on Bird Construction.
Bird Construction's a good company. It's the stock has done great in the last 4 months, up 55%. We think it's at a very high valuation. Free cash flow in the year will be about $1.30, trading at $47. That's a lot. And remember, it is in the construction business. Mm-hmm. It's a very volatile business. These guys have done very well. They've made lots of acquisitions that may or may not mask some of the issues. But construction is a volatile business. They say that their backlog, the strength is their backlog. The backlog is up 45% last year. It was roughly $6 billion 2 years ago, $9 billion now. But, those backlogs change. Slow down in construction, a slowdown in some projects, big impact. Secondly, they say margins are going to go to 8% in 2027. Margins are 6 to 7% in the industry in general in Canada amongst all their competitors, and they have been for them as well. All of a sudden, they say they're going to get outsized margins. May happen. I don't like to bet on that. Seems to me if you're gonna have to bet on something that's outsized, you want to earn it. You don't want to pay for it.
Yeah.
So I think you're paying for something that you're not that is you're not getting.
That may not be there.
It might not be. Might be there. Might not. Just at this valuation, it's too tough to call.
What would you like to see it at for a valuation?
Oh, a lot lower. Don't ask. A lot lower.
All right, I want to ask. Okay. Next up, email from Craig, and the subject is GFL. What are your thoughts on GFL?
I like GFL a lot. GFL is a very simple business. They have contracts to pick up garbage from municipalities and businesses. These contracts are usually very long-term, and it throws off a lot of cash. Also has had a lot of that. Last year, they sold a division of the business, got a huge premium for it from what they expected to get, which was nice. But the big thing is their core business is doing really well. They just made announced an acquisition of Secure Waste, which we talked about a minute ago.
Yep.
The stock fell 13% roughly from 63 to 53. It's now back to 55 on that sale. Secure fits their profile perfectly. The criticism mostly came out of U.S. analysts. U.S. analysts didn't know anything about it. They took a quick look, found out Secure's in the oil patch, said, hey, they're getting in the oil business. It's not the oil business at all. They just collect waste from oil companies. Again, they own 70% of the market. It's a very stable business, long-term contracts. Nobody's going anywhere. Great management. They had sold a piece of their business to Secure Waste and sold a piece of business to Waste Connections. The Waste Connections guys say management is great. The piece they sold isn't their best piece, obviously. Yeah. So management's great. I think it's going to be a superb acquisition for him. It's going to be accretive. And the thing about Secure is it generates lots of cash, has very little place to use it. GFL has lots of opportunities in front of it. Just made a big acquisition in Texas a month ago. GFL has lots of opportunity to continue to consolidate the industry. I think you'll see it double over the next few years.
Okay, let's get to the phones right now. And Frida from Chilliwack, what's your question?
Hi there. Please help me out with Microsoft. Thank you.
All right, that was short and sweet, simple.
Sure. I don't know what to help you with, but we like Microsoft. Microsoft, the software businesses in general, the stocks have been pummeled in the last few months. Stocks way down. It's trading at a very reasonable valuation. You can see it on the chart, the pummeling. And the big thing is it's still growing at 20-odd%. There is an interesting wrinkle in Microsoft, which I think is really good, which is they own an AI. They have interest in almost every other AI property as well, but they have something called Copilot.
Yep.
When you talk to businesses and you say what AI do you use? Almost everybody says they use Copilot. Why? Because Copilot it integrates with all the other Microsoft data that almost every company has as their source data. So even if you wanted to use Claude or some other system, you've got to get it through Copilot.
And try and get it into.
So I think that I think that will be a huge success, and we've seen Microsoft do this with a lot of other products where, in the end, because they've got this huge embedded database in almost every company, you have to go through their product. So I think that's going to work out to be a hugely successful thing.
What about? Sorry, go ahead.
Go ahead.
No, finish, please.
No,
okay. Just that news today that Microsoft and OpenAI, they've agreed to drop the software's exclusive rights for OpenAI.
Yeah.
No concern?
No. I mean, as I say, Microsoft owns a chunk of Claude, of Anthropics. Yeah. It owns it's got a piece in a whole bunch of different. It owns some ChatGPT. It's all over the place. The big thing is what these guys are doing themselves and how this is going to evolve. I mean, the fact of the matter is, you're in a very, very early stages of AI. Nobody knows how it's actually going to evolve. I mean, we use it a lot. It's really it's amazingly helpful. Speeds things up. It allows you to do all sorts of things you couldn't do. You can code. We're coding some stuff right now in our office that with somebody who's not a coder, we go outside for it, and it's doing a great job. So you can, it's got tremendous, but it's also, Mythos, the new Claude program, is able to detect holes and hackability, if you will.
A little too quickly.
That's scaring every major corporation because they send out patches all the time, how to fix it, but the patches come in so frequently you can't test it before another one comes in. So it's the AI is moving very quickly. But it won't evolve the way we expect. So who knows?
Okay, well, we've got to take a break right now, but we'll be back with Richard Fogler of Kingwest Company, taking your questions on North American Equities. All right, let's get back to your emails and calls. First up is an email from Albert, and Alphabet reports this week. What are you looking for, Richard?
So we don't generally focus too much on quarterly earnings. I said we're long-term holders. We believe that it's going to work out. It's going to be very well. It'll work out very well. The one thing I will say to you is that Alphabet has outstripped its guidance, if you will, or the street estimates. I think for over 6 quarters. Every time that it is reported in the last 6 quarters, the stock has moved up about I think it's 8%.
Okay.
So big moves. So I wouldn't be surprised. I think they'll come out with good numbers, and I think you'll see again a pretty good move in that. Interestingly, Microsoft, which I just talked about, has also outperformed. Stock has not reacted much initially to it. It's the market. People are funny.
I mean, I thought we might have been hitting that point at the end of last year where even no matter what they did for their earnings report, it wasn't enough for people. But now people seem to have gotten back into tech and back into AI.
Yeah, I mean, first the earnings numbers have been coming in. They're doing way better than expected, or better than expected. Yeah. And the economy's, it is really driving forward. So it's good. It's been and the whole if you look at the quantum of all of them put together, that supports a positive view for the market itself.
All right, let's not bring quantum computing in just yet.
We're
not ready for that.
We don't want to do that one.
All right, let's get another email in. This one's from Jordan. How has JPMorgan's recent performance compared to its major banking peers?
JPMorgan is the sine qua non of banks.
Yeah.
And it's the sine qua non of banks because Jamie Dimon, who runs it, has been arguably the best banker in the world. He's also, by the way, a very major shareholder. So he's done very nicely, and deservedly so. The bank continues to do well, sells it at a very high multiple, but on the other hand, it earns a 20-odd%, 23%, I think, rate of return on capital. The average Canadian bank earns 16%. So it should sell at a higher multiple. It's generating, a lot more money for the same dollar of investment. I think we've owned JPMorgan for 15 years. It's done great. I think we paid $20. It's 300 and something.
Yeah, 310 right now. Yeah.
Yeah.
That's not bad.
No, it's not bad. And we've been getting dividends, and I think it's going to continue to do well.
What could be a possible headwind for it, do you think?
A couple of things. There's going to be an economic slowdown. But Jamie Dimon's getting older. If he were to decide that, enough of banking, I want to sit on a beach somewhere, I think that would be a big problem.
A big issue.
They've got real depth, a great team. But I mean, he has stood out. I wouldn't want to bet that anybody could do it. Could be as successful as he was.
Yeah. All right.
Even though they may be. Okay. Hopefully.
Well, never know, right? Never say never. Okay. This one's from Heather. How sustainable is HCA Healthcare's earnings growth given current labor costs, reimbursement pressures, and patient volume trends? Patient volume trends. People are getting older. Hospitals are getting more densely used. And they have a big outpatient what they call urgent care facility, what we call, clinic, patient clinics here. I've used them myself. They're actually terrific. But anyway, the big thing is HCA it's an extremely well run, doing better. We like it a lot. All right. And healthcare's kind of been beat up a little bit for the last while, but it's been bouncing back, though, right? It's
been bouncing back. If you take a look at that chart, you can see it's beaten up a bit from the high, but not much of more of a minor headache than a migraine.
Which you could get treated for. Okay, we're going to take a quick break. When we come back, we'll take a look at Richard Fogler's new top picks. Join us tomorrow on Market Call. Andrew Moffs will be on the show. He's the Senior Vice President and Portfolio Manager of Vision Capital. He'll be taking your questions on real estate stocks. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for Richard's top picks. And first up, the TMX Group, which has been in the news.
Yes.
They just acquired, was it CBOE,
Yes.
Australia and Canada.
Correct. So TMX Group is the company. It owns the Toronto Stock Exchange, the Montreal Exchange, which is mostly derivatives and bonds. It owns the Clearing Corporation for all Canadian bond and then it owns NGX, the gas trading platform, natural gas play, and Trayport, which is a software that supports all that. As you put all those things together, you find it has a unique position in the Canadian financial industry and in the United States in these resource areas. TMX is this stuff is not a trading platform. It's a toll road. Everybody who uses these things must pass through. They get their piece. They have just announced last week, we'll see if it goes through, the acquisition of CBOE Canada. I'm going to catch myself on it too, and CBOE Australia. Let me talk about first of CBOE Canada. CBOE Canada is the only alternate trading platform left in Canada that's not owned by TMX. Ergo, when they buy that,
they own
monopoly.
They own the street.
They own the street and pricing, and they don't have to worry about pricing. And they own all of the data.
Could that be a deterrent for that deal going through?
It could be. And if they buying Australia, so TMX, TSX, the exchange and the venture exchange, have nearly 50% of all mining listings in the world. The second largest listing are in Australia. Combine those, you've got by far the powerhouse for mining and natural resource.
Yeah.
So that as well is a big thing. Thirdly, as you can see, this is a company that's been going around for a long time. It's been public since 2003. We bought it on the IPO, 2003, $3.50. We still own it. You can check the price if you feel like it. But it's done pretty well, and it's paid some good dividends. But as I say, it's a consistent earning. And the management the outlook today is every bit as strong as it was 20 years ago. As it is as strong today as it was 20 years ago. We have lots of optionality on this.
Would it be a setback if the deal doesn't go through?
Yeah, the deal's going to be great for it. If it doesn't go through, that wouldn't be good. But it doesn't make it worse. It just makes it.
Yeah.
It doesn't make it as much better as it would have been had that deal gone through. It was a terrific. All
right.
Deal.
We got to get on to the other two here. Citigroup. What are you liking?
Citigroup is the most underappreciated U.S. bank. It has for 20 years been a major disappointment. Every time it picks up its head, gets knocked back down. Basically a conglomerate bank. Jane Fraser, the CEO, has been the first person to reorganize it, and she is shrinking the bank to expand it. They've disposed of all the consumer banks all over the world. They have focused on corporate and institutional business, high net worth individuals, and they have one of the largest credit card businesses in the United States, and a small consumer bank, which there's rumors that they may expand in the United States. They have their money trading business provides liquidity transfer to every major corporation in the world. They are the only people who have access 90 plus countries, been building this thing for years. It is totally not replaceable. It's certainly not replicable by anybody else. A wonderful business. And again, to use the words I used on the TMX, it's a toll road. Everybody plays through it. So the big thing is, it's been crummy. Jane Fraser starting to get it better. See, ROE is in the last quarter was 13% versus their target of 10, and 9% a year ago. It's doing better, and margins are improving. ROE is improving. Stock will.
I want to sneak in the last one because we're almost out of time. You got about 30 seconds for this one. Smith & Nephew.
Smith & Nephew is a medical services company. They do orthopedics, that's knees and hips. They do sports medicine, joint repair, and they do basically dressings and things like that, wound care. To make it really simple, the company's done crummy. New management in the last 4 years is turning it around. Profitability is improving, revenue is improving. Old company, lots of brand recognition, trading at half the value of its biggest competitor, Stryker. We think that the profitability will come in. Margins were 20%, Stryker's are 26%. Their margins are moving up. We think they'll move up to the equivalent of a Stryker. We think the stock is probably going to double. It's trading at half the value of Stryker. We think they'll trade on par over the next few years.
All right.
That's the business.
We got to wrap it up there, but Richard, thank you as always for joining us. Appreciate it.
My pleasure.
Richard Fogler is Chief Investment Officer of Kingwest Company. Thank you very much for joining us. And that's it for Market Call. We will see you next time. Enjoy the afternoon.